France's political crisis makes European bond investors nervous again, but does Britain have even more to worry about? Credit ratings agencies have issued a fresh round of warnings about France's sovereign debt score on Monday after its third prime minister in a year resigned in a political impasse over the budget. Market nerves about the scale of borrowing sent bond yields up around the developed world. But bear in mind that while France is being threatened with a downgrade, it's paying a 3.5% yield on 10-year borrowing. Britain is paying 4.7%. James Smith is a developed market economist at ING. James, of course, bond yields are rising everywhere, but this does throw the UK situation into stark perspective, doesn't it?
It's a very sensitive situation. And actually, the fact that bond yields are climbing in the UK largely reflects expectations for the Bank of England. The Bank of England has been a bit more hawkish this summer. We've seen a bit of a divergence between the way investors are pricing interest rates here in the UK versus, say, the US or Europe. So that's doing a lot of the work. But clearly, markets are also sensitive to the upcoming budget at the end of November. Borrowing is pretty high in the UK. A lot of gilt issuance that investors are having to absorb at the moment. They're very sensitive to see, are we going to get more borrowing coming through? Are there going to be serious tax hikes?
And with the budget looming in late November, did we get much sign from last week's Labour conference of how that gap might be filled?
I think it's still very unclear. I think what investors are looking for very closely is whether those tax hikes are going to come through one of the major taxes, so income tax, VAT, national insurance. These are the things that really raise the most revenue here in the UK. Or is it other stuff where the revenue is a bit more uncertain? Are tax hikes pushed back into the future? Do we get a boost to spending next year as well, which makes the hole even bigger? These are the sort of questions we're asking over the next few weeks. But no, I don't think we've got a huge amount of clarity from the Labour conference last week.
Do you think then that the uncertainty is so high that some of the weak data we've seen, particularly in the labour market, is just a sign that businesses have frozen activity until they have more clarity?
I think there's an element of that. And clearly that's not just down to the UK. Tariffs and the global story have played into that as well. Private sector payroll employment is down about a percentage point so far this year. Admittedly, a lot of that is in hospitality, and a lot of that can be traced back to the tax hikes we've already had. The big hike in national living wage, as well as put pressure on the hospitality sector. I think the interesting thing actually is that government hiring has really offset that. Government employment has risen more than a percentage point over the last few months. But will that continue into next year? Because the spending side of the budget is getting tighter over the next few years. So that's a key question coming out of this budget.
Rachel Reeves, of course, would love another Bank of England rate cut before the end of the year. It would make her life slightly easier. But what are the chances?
Well, until now, I've been thinking we might get another rate cut in November. Clearly, that would be good news ahead of the late November budget. But I think that's becoming less likely. Investors have largely priced that out at this point. Inflation is proving stubborn. And the Bank of England is really focused on headline inflation, food inflation specifically, which is rising at the moment. And it's set to stay fairly elevated through the rest of this year. So that kind of dampened expectations for cuts. I still think we're going to get more cuts than markets expect. Markets are barely pricing one more cut from here. I think we're looking at another 2 or 3. But the timing of the next move is uncertain. It's looking more likely December or maybe February for the next move now.
Do you think we'll see a broader split of opinion at the next couple of meetings among policymakers themselves?
Definitely, and we're already seeing it, because I think you've got those on the hawkish side who are looking at headline inflation at the moment, worried that it's going to become more embedded, just as it did 2 or 3 years ago. But you've got others who are saying, look, wage growth's coming down, the jobs market is fragile, the UK economy is not exactly going great guns at the moment, and on a more forward-looking basis, that should help inflation come down. And, I don't think the data has really resolved that debate so far.
That was James Smith of ING. Don't forget, you can watch more videos on Reuters.com.